What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. Today's date is November 10th, 2020. Thanks for letting me get this video out to you a little bit later than usual here. Was out with dinner with my family out here on vacation. Appreciate all the kind words that have been coming in through the comment section. In today's video, got a lot to talk about, but I really want to kind of dig into whether or not what we're seeing in the markets is setting itself up for a market melt up, and or if this is a gigantic bull trap. Potentially none of it at all. You know, maybe this is just up and down movement. But in order to do so, we use technical analysis, and we're going to be looking over a certain sector that we've been talking about here pretty frequently. We're going to go over some indices, and then we're also going to be talking about yields, indicators, commodities, the dollar, and then my overall conclusion. And the reason why we talk about all those things is obviously just to get a better idea and a good picture as to what's going on from a more macro point of view. Let's get into it today. Let's start off by jumping into the sector spotlight. So today, obviously here you can see all the different spiders that make up the S&P 500. Energy sector outperformed once again another day. It's 2 days now in a row that it came in the top spot, and we know that the energy sector has been getting beat down quite significantly these last 3 to 6 months. I pulled up the energy sector, and I want to point out something very interesting here. So first off, we did point out this bullish divergence taking place quite some time ago from here in October to November, and we called that out. And you can see that the price action was lower, but the RSI was signaling that, hey, this market might be setting itself up for a bigger move. And boom, as you can see, another up 3% today. So we're up pretty significantly from 28 and some change all the way up to 34.13 in a very rapid movement, so 2 days. But what I wanted to point out here is the RSI is getting into that oversold territory, and the last time that happened, I wanted to show you just how similar this whole setup looked. So here in June, we had this big, massive gap up, then a hanging man candle, and then we started seeing some action back down to the downside. So part of me thinks, hey, maybe we're seeing something very similar take place here. We had this massive gap up. We have a hanging man candle. We're going to need some more confirmation here to see what takes place. But in the meantime, I did pull up some energy stocks just to see kind of what maybe might be looking pretty good. And this one on the weekly time frame, this is GPP. By no means am I recommending this to anybody, but an ascending triangle coming from a bearish, obviously, pull down here in March. And like I said, this is on a weekly time frame, which means each candle here is a week's worth of data, and then it's kind of building up this nice momentum here. It has a little cup and handle pattern. It's about 12 weeks worth of data right there in a cup and handle. So if we can get above this 50 period weekly moving average right here, that might actually signal that this potentially has some more legs to go. But like I stated already in the previous chart, that this potentially might not be what we think it is. This could be very temporary, and we'll get into the crude oil here shortly when we get into the commodity sector of the video. But I just thought that was important to point out. Let's go ahead and talk about the indices, starting with the S&P 500. We're going to look at the weekly time frame. Yes, we popped out of this symmetrical triangle, and we're getting rejected, even though we made an all-time market high. Didn't close there. Actually, no, we did close there at an all-time market high. I take that back. But we went even higher than the previous high over where my pointer is at. And what's interesting is it got rejected, and now it's forming a shooting star candle. And obviously, we have time still. Plenty of time left in this week still. Today's only Tuesday, so it's going to be interesting to see how this wraps up. But coming from a huge move to the upside, this is a big rubber band type week. Now we might see some interaction to the downside. It's going to be interesting to see how this plays out. But what I want to point out here is that this resistance up ahead is still holding. So really depends on where we close for the week to really determine, hey, is this setting the stage for a breakout, and then we're just retesting the symmetrical triangle and moving up? Well, in order to really tell, we're going to have to look at some smaller time frames, mainly the daily. The daily is what really kind of gets me kind of wondering, hey, is this actually the melt up, or is it going to be some more time before we start seeing this market really get its legs to move higher, or just trap us? And the one reason why I don't really trust all this breakout is because of the monster gaps that we saw pushing to the upside. So we had 1, 2, 3, 4, and we even had 5, but now this one just closed. So As you can see, we had the Bollinger Bands. That's that blue kind of shaded area. We had this shooting star candle, and we moved to the upside, way overextended, and then we pulled back in, creating a reversal candle. We did see some confirmation to the downside, being that we closed below it. However, you can see that the price action pulled down, almost tagged the 5 EMA, so we're still extended from it, but then it bounced from this area that it kind of broke out from. Now, typically when you get when resistance is broken, it can get retested, and that's what we're seeing take place right now. But being that today was such a choppy day, and I could show that here on the 30-minute time frame, might mean to us that, hey, this potentially could still head lower or still potentially go higher. Now, the reason why I think that it can go lower is because there's still a lot of gaps to fill, and we have been seeing these gaps get filled. So this here, like I said, is on the 30-minute time frame. So gap, 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 gap. Now what we're seeing is this day really, has just been kind of creating this ascending type triangle. 50 period moving average has been kind of holding, but we're still below the 20, which is more intermediate term. And it's going to just be interesting overall how this one could play out. But as you can see, it's kind of building up, still trying to hold strong and then potentially move higher. The last time that did that, you can see that right here, where it kind of built up strong, got resistance, and then we had that big gap up. So are we running out of steam here, or are we seeing something that very similar took place here right around, I think that was November 11th or just right before that. So as it stands right now with the S&P 500, there's no clear communication. There's no clear, momentum, I should say, of whether this can go potentially up or down at this particular moment. The support from the breakout, it just got retested, didn't reconnect with the 5 EMA. Tomorrow or the remainder of this week could get very interesting. Let's look at the NASDAQ 100. I'm going to kind of try to pick up pace here a little bit. NASDAQ 100 on the weekly time frame. False breakout, retagged the 5 EMA. That's what I wanted to only point out here. We're back within this symmetrical triangle period. On yesterday's thumbnail, I said that this was a false breakout, and it has confirmed that that was a false breakout for now. On the daily time frame here, we didn't make a new high on the NASDAQ 100. And what's interesting is even today we had this gap down, push lower, tagged a little bit down here. I think this is the 50 period moving average, and then we found some support right from there and closed on the 20 period. So we retagged on the 5 EMA, and we created another gap to the downside. So now we had a gap that we got from the upside, and then now we had the same gap right below us. So it's kind of interesting. Now we have two gaps above us, two gaps below us, and this hammer candle found support at the 50 period moving average. It's really anybody's bet here, but from the looks of this, we might want to potentially catch a little bit move, close this gap above us, and then maybe get rejected to head a little bit lower. But this 50 period so far is still holding up. Dow Jones on the weekly time frame, huge gap on the weekly time frame, disconnected completely from the 5 EMA. It's going to want to retag it here. The Dow Jones, even today, once we get into the daily, decent day, but keep in mind, it's just a little sketchy here when you're creating this kind of doji candle and this big gap up for the week. So it's going to be interesting also to see how this one plays out. To me, I feel like on this weekly time frame, we're going to want to see this one get retagged on the 5 EMA, and then we might see continuation to the upside. But as it stands right now, it's kind of just floating up there in mid-air. Here we go on the Dow Jones on the daily time frame. This gives you a better picture of what I mean. We had all these gaps blowing to the upside, shooting star candle. We could not get below the low of yesterday's candle. We found a little bit of support there. So are we going to be consolidating? I personally think that this gap is going to move down and get retested. We're so disconnected from the 5 EMA. I don't have the Bollinger Bands up. I should have probably pulled them up, but I would imagine that we're right there next to the top Bollinger Bands. And then when you look over here on the RSI is just about overbought, and last time was right around there, that section of overbought. We did see that pull down. So this move is just overall very, very extended. But once we get into the indicators, I'll show you why, maybe we might get a little bit of pullback, but then we might find our legs and then start moving in the upwards direction. It's very hard to determine right now at this time, but let's keep on going. Russell 2000, also a strong performer for the week, up 5.5%. Big gap up, very similar to the Dow. I had this rising wedge kind of mapped out, and I'm still going to keep it here. Came all the way back to retest it, closed up a little bit higher. Overall, the Russell is really outperforming everything as we see it. So it's going to be interesting also to see how this one plays out, but we're very disconnected from the 5 EMA. Chances are we're going to get reconnected with that here in the very near future. And that is the wrong chart, so let me go ahead and delete that. I was going to actually show you guys the IWM the Russell 2000 on the daily time frame, but I must have loaded it in wrong. So let's just go right to the regional banks. It's not too important at this particular point in time anyway. But the regional banks, what I want to show here was that inverse head and shoulders ascending triangle pattern within it. And then we saw that breakout. When the banks, when yields, I should say, which we'll get into here, rise, banks typically do good. So I'm trying to watch to see where this is coming into the previous resistance. We're right at 86.92. If you look back in the history of the chart, that's kind of right where it got rejected as well. So it's also, and then I take a look at the RSI, we're getting to overbought territory. This could be where this potentially turns around. Very early to tell, but we got this big, huge move to the upside in just the last couple of days. So maybe the banks might be taking a breath here very shortly. Yields, you know, as I've been saying, banks make money when yields are high. So you got to look at the long term versus the short term. And really, you know, why is that? Well, banks borrow in the short term and they lend in the long term. So the higher these rates go, it's better for them. And really, the banks, the yields today close at 0.98 for the 10-year. That's a widely tracked. Same with this 10-year minus the 2-year spread. The 10-year to 2-year spread has constantly been rising. So this is right around a 2-year high, if not a little bit more now, but right around a 2-year high. And every time it comes in and touches this trend line, it seems to bounce up and then eventually pull back. So we've been watching that since August. So, you know, maybe we might come back to retest it and create another higher low, and it might just kind of find its way doing that. Now, it's very interesting to see yields rising and kind of, you know, I wonder how high yields can really rise until pressure's really put on, you know, anybody that owns debt. So, you know, it's just when yields rise and banks can make more money, well, it hurts the American people. Now, when the spread increases like this, it's also interesting thing that's the bond market pricing in future growth and inflation. So how high can rates really rise until the squeeze kind of starts taking place? And right now we're seeing yields significantly rise these past couple of days quite tremendously, and this could be all because of the presidential election and what's kind of going on. We're trying to find our ground. What's going to really take place? Is it contested? Is he going to contest, or whatever the case is? Concede, is that the word that I'm trying to look for? Yeah, I think that was the one. But you know, we're really on pause with just extreme volatility and really just lack of momentum, I should say. It's time to get into the indicators right now. Let's look at the Pring Bottom Fisher. I've talked about this a few times, so if you're new here and you're not too familiar with what the Pring Bottom Fisher is, this helps us at finding market bottoms. But what we like to see and typically want to see, to find a market bottom, you need to see the blue signal line cross below the 10, and you also want to see the green lines cross under there too. Now, it's not always the case, but it kind of just adds to the power of this indicator. As you can see down here is below the green and the black line, and when the blue signal line crossed above the 10 period moving average, you can see that it really found that market bottom right there, quite on point. And then right here it did the same exact thing. So you can see if we scope right up, that was right around the bottom of this inverse head and shoulders on the right shoulder, and boom, we saw that squeeze to the upside. And then we came down. This is still heading lower, and now we kind of reached a high point. But what's interesting to me is it's starting to kind of curl itself a little bit over. So maybe the market might fall down just a little bit further, and then maybe the 10 period will continue to move down because it's a lagging indicator, and we might cross both back above it once it finds its legs, and that could potentially signal the start of what we were talking about. Hey, maybe that's where we're going to start seeing more momentum to the upside that could potentially create a melt up, and or, you know, I mean, it's funny to think like, but people say, you know, melt up, like, is that going to just continue to go, or is that actually just what a bull trap is? So they could be one and the same, or, you know, it could be just melt up, consolidate, then move higher, consolidate, then move higher. There's so many different factors that can potentially take place, but we need to just be prepared. So what I'm seeing right now in the markets, like we've already stated, is all these gaps lead me to believe like they kind of want to get filled and kind of die from all of this, you know, momentum craziness, this uncertainty in the markets, I should say, to the upside. When you look at the VIX is throwing all kinds of curveballs at us. Still, you know, I mean, it's still really just, I mean, we're high still. It's like 24 overall. I mean, it might not look like it on this chart, but still we're relatively high. And we have this gap below us still that hasn't been filled. Now, keep in mind, this is kind of works inverse to the S&P 500. So when this moves lower, the S&P 500 can move higher. When this goes higher, the S&P 500 could move lower. And what we're seeing right now is, what I'm watching for right now, is a continuation to the downside into the lower Bollinger Band, because sometimes when it gets too stretched out like that, we could see a rally for a couple of days in the S&P 500, depending on where it's overextended. So when it got overextended here, obviously it came down, which means the S&P 500 went up. When it got up here, same exact thing. Right here, same exact thing. So if it comes down here, maybe then we might start seeing the S&P 500 go down if it does move in the upwards direction. So we got to keep an eye out on that. Here's the NYMO, and this right here we've been really keeping a close eye on. This is very similar to what happened in 2018, where the all-time market high hit here in 2018 on negative breadth. We saw the same thing happen here in 2020. And then you can see the pattern: down, up, down, up, down, up, down, up. And then it has the same type of breadth, very sharp movements to the side. Now this one really shot down very strongly on a negative breadth. And what we're seeing here is a negative divergence. I wanted to map that out. Obviously the price action's higher than the previous peak. Not here so far on the NYMO. Now that can change, so I'm just keeping an eye on it though. So if we start seeing a very sharp pull to a negative breadth, that could very well send us back to fill all those gaps below us, and even potentially go lower if it matches 2018 from the 3,100 to the 3,000. So we're going to kind of really want to just monitor this one. Here's the BPNDX. BPNDX isn't showing us too much. It's not quite overextended to the upside or the downside. It did get up to around 75, and the last time it was right around there was in September, and that is when the market did pull down. So overall, yeah, this could potentially mean that's an overextended move, but when we're looking at the RSI, it's not quite overextended yet. Here is the NASDAQ 100% of stocks above the 200-day period moving average. That basically means whatever this number is, so 86 right here means 86% of the stocks that make up the NASDAQ 100 are above the 200 period moving average. Some people say you can't use this indicator. I say that's malarkey. When it gets super overextended like this and you see that the market is running into areas of resistance, chances are this is going to hold up. And as we saw when it got over there, when I did notify it, we had the pull down pretty steeply in the NASDAQ 100, and now we're still seeing it above 86. Does that mean there might be more room to go? Well, when we looked at the price action, what did the price action tell us? The price action said that it was bouncing from the 50 period, so maybe we're seeing just a little bit of chop now before maybe a move lower into the bottom portion of the trend line. Or, you know, maybe we catch more of a breath or run on some sort of market news. It's hard to say, but we're looking at those key levels. The last indicator I want to talk about is the CPCE on the monthly time frame. So this is a longer term time frame. But what I wrote out here was when the monthly CPCE reaches the 0.45 extreme level, the next 5 months become quite volatile. And as we've seen here in 2005, 2008, and early 2010, we had swings from right around these ranges take place. Now we're even lower. What does this mean? What is the put to call ratio? Well, the put to call ratio, the lower it goes, it means the more bullish the equity side of traders are. So this is just a sentiment indicator letting us know. Now, it's interesting to see that it's at this all-time low and we're at pretty much an all-time high in the market. So everyone's extremely bullish, which, you know, the next 5 months, as we've been stating, it previously hit here and then went lower, could become quite volatile. And we've already been seeing that, just huge swings in both directions. Let's go ahead and look at commodities now, starting with gold. Gold had just this massive down move. Now, I did mention this, not on last market brief, but on the one before that, I believe, is I wasn't trusting the breakout quite yet because of looking at the equities markets and seeing all these gaps to the upside. It didn't quite make much sense to me. And, you know, we saw this big pull, so good thing that we waited right there. And it came into almost my buy zone, literally almost perfectly, but didn't quite reach it. So I did not buy any more gold. I'm going to wait to see here if we can get a little bit lower. If it breaks through this pink or the bottom, I would say right around 1750 to 17 to 1800, right around that range. So about a $50 range. You know, have some dry powder ready because that could be a very good opportunity to get into some gold. Here's silver. I did map out this a little bit differently than I had it previously. Descending triangle, saw this big leg to the downside. It got rejected from previous resistance and didn't hold the 50-period moving average. Kind of still building up a little bit of higher lows right here, but ultimately the main support is right here at this lower blue horizontal line, which is about 2250, give or take a few cents right there. So if we start breaking below that, I'd be looking at this 200-period moving average. That's at $20.24 as support. Then we got Bitcoin, still oversold territory. We said that back here that it can hold in the oversold territory for quite some time. Then we got this big run up to the upside. Now we're creating a very tight inside trading day, very clear symmetrical pattern. Are we going to see a continuation to the upside, or is this going to break down? Time will tell, but with this big bullish momentum to the upside, it could very well just trigger us higher. The only thing is the RSI is getting pretty frothy here, so we'll see what takes place there. Last one I want to talk about is WTIC. This is light crude oil. We've been having a good couple of days here with light crude oil. Today specifically up 2.66%. This gray box is kind of a range that I mapped out, and right here created a bullish divergence. We saw the move to the upside, came back down, tested this kind of area of support, and now we're getting back into this area of resistance. So the energy sector's been doing great, oil's been doing great, but now we're kind of pushing into these areas of resistance. Maybe this was temporary, I should say, or maybe this is the stage of a breakout that we need to be prepared for. And what do we mean by be prepared, or what do I mean by that? Well, it means that, hey, if we start seeing strength in stocks, that's going to be the time where we can start looking for breakouts or continuations and start trading into that momentum to create opportunities for ourselves. Now it's time to talk about the dollar. Here's the US dollar. We said that if it came down to 92, it probably would find some support. Boom, it was over here, found support. That wasn't when we said it, but that's what we said over here. Came down, bounced, found support. Is this just a temporary bounce to potentially head lower? I guess we'll see. It's still trading within this range. If it gets above 95, that's good for the bulls. If it gets below 92, hey, that's going to be good for gold and silver, but that is obviously clearly going to, be bad for, the dollar bulls. So let's go ahead and kind of wrap this up. First off, really, before I kind of wrap it up, I want to show some just big, industries that make up for the NASDAQ composite as well as the Dow Jones. And starting with the SOX, that's a semiconductor index. Really, you've seen this map. I mapped this out already. We had a bearish divergence, okay, right from this peak to this peak. And we mapped it out here. Now I extended it, and I said, okay, this looks like it's going to turn over. Then when we came down here to the 50-period moving average, we said this is the area where you should start looking at semiconductor stocks to potentially find and buy that also are running into areas of support. And then we saw this big run up, and now it's getting rejected from this upper trend line, and it's not creating a new high here on the RSI. So, hey, this is why the reason why I'm showing you this is this can very well be some sort of fake out bounce, and then now we're going to be heading potentially even lower or back to the 50-period moving average. So we're going to have to monitor this. And the semiconductor index, this is the SOX, but the semiconductors make up a huge part of the NASDAQ composite. So we need to make sure that we're keeping an eye on this kind of stuff, because if the semiconductors really get beat up, we're going to see a lot of pressure on the NASDAQ. Here's the Dow Jones Transportation. Dow Jones Transportation also makes up a huge portion of the Dow Jones. And you probably heard of the Dow Jones theory, or that I can't exactly really remember the term, but that basically what it's doing is it's looking at the Dow Jones to the Dow Jones Transport Average. And what I want to show here is very similar. We saw this pullback here. We said if it comes down to around the 50 period, this is a start time to look for stocks that make up the transports. And then we've seen airlines and other transport stocks do really well since it found this little bottom here at 11,000. 11,000 right there, and now you can still see there is still a negative divergence taking place. So maybe this is one big run, and then we're going to get rejected up here. It's too hard to tell, but as you can see, it is making a new high with a lot less data here from the RSI. It's still bearish divergence. So what I really want to wrap everyone's head up is, if you're seeing certainty in the markets, people are saying there's going to be a melt up, or there's going to be a crash, there's going to be this, there's going to be that. Be very aware of all the data that's surrounding everything. You can just simply pull up charts, and they will tell you what to expect. When things get overextended in one certain direction, both from a breadth, sentiment, and even a price action move, you're going to have these pockets of time where it has to consolidate or pull back, and or vice versa. So right now, as I see it, the markets are really trying to decide what they want to do. And from my, perspective personally, it seems like the market wants to pull back, but it's not being allowed to at this particular point in time. There's a lot of gaps that push the market up in this vertical movement. And whenever there's, some stocks that go down or things don't go that great, it doesn't seem like the market really, it almost like the market pulls back, but then yet people want to buy these very, very small pullbacks because they don't want to miss out of what could potentially happen. So like I've been saying for the last couple of weeks, I am happy to be out of the markets mostly. I made a few trades here and there, but you need to still be very vigilant, very agile in these type of environments simply because of this crazy price action. We're living in a time, obviously, right now in the markets where this kind of action has never happened before, and now we're at all-time market highs. I mean, you can look back to 2008, right? You can look back to 2000 when we were at these all-time market highs and all. You see all these crazy price action swings, and maybe that's a signal for us. Maybe that's pump the brakes. If you have some profits, make sure you're taking them. If you're being loose with your money, you're gambling with it, don't fall victim to what other people have fell victim to in the past, where they leveraged up to incredible amounts and then the next day they woke up with nothing. Like this is about capital preservation. This entire thing is about saving money and protecting your capital and growing it over time. It's not about getting rich overnight and over leveraging yourself to wake up with basically nothing. So that's really all I have for you on today's market brief. I hope this kind of gave you some more clarity in the markets. If you have any questions, comments, concerns, emotional outbreaks, you can leave them in the comments section below. And like always, follow me on social media. I post things on my Twitter account at Mike P. Silva. I have my website up. I'll be posting more there when I get back from this vacation. And then I also have an Instagram account, figuring out money there as well. See y'all later. Bye.